Hi, my name is Ozzie Jurock. I'm the host of OzBuzz, where we pride ourselves on inviting eclectic and successful people in and around the real estate umbrella. And today we're very fortunate to have with us Mr. Kyle Green, who has been in the mortgage brokerage industry since 2006 and has funded an unbelievable $1 billion in his career. But not only that, he's the owner of Green Mortgage, which has been in the top 25 of funded volume in Canada since 2017. That's an incredible record. And if that wasn't enough, he's also the owner of Origin Mortgages, a brokerage in Vancouver with over 50 agents, which funds more than $1 billion per year in mortgages. So in addition to that, he specializes working with investors since 2008. He's been a speaker at many of our Land Rush events, and he's helped literally hundreds and hundreds of investors create mortgages that they were turned down elsewhere. So welcome, Kyle.
Yeah, happy to be here.
Well, we're in an interesting world. We're in August 2023, and is it the right time to buy real estate?
It's a good question. It's a hard question to answer. I think that the tough part is, as it stands right now, with interest rates going up as much as they have, and values coming down a bit, but not enough to offset this cost. It's hard to say that now is a great time to buy real estate. I think that the tough part and the difficult question here is, where are we going to be in let's say 2 years' time? Right now we have a ton of immigrants moving here. All these people are going to be looking for housing if they aren't already looking for housing. We also have a interesting situation where I know that a lot of the small to medium-sized developers that we work with are choosing not to start projects right now. Their margins are getting compressed considerably because of concern about inflation, inflationary pressures on their costs, and also having to pre-sell units at today's low prices or depressed prices makes it a little bit more difficult for them to justify that. And then you throw in and mix in just a little bit of interest rates falling in the next couple of years, and you have a perfect storm for initially what I thought might be a mini boom, but now I'm thinking it might be a full-on boom in about 2 years' time. Even when interest rates fell earlier in the spring here, just a few months ago, the interest rate environment had dropped and values had started to come back up again in a very short period of time. So it doesn't take much. I think there's a lot of people sitting on the sidelines wanting to buy, and I think the problem is that if you buy in 2 years, I think it'll be a worse time than it is today. So is now a great time to buy? Not really, but is 2 years' time better? No, I think it'll be worse. So, the advice to a lot of our clients is buy, or at least consider buying if you find a good deal with maybe a short-term fixed rate mortgage. And then when that comes up for renewal, your costs will reset and it'll be a much better deal at that time.
Well, certainly that's exactly where we are. I mean, in my own view, there's several questions you have to ask yourself whether you should buy. And the number one question, do you expect an inflationary environment or not? And I've been writing in my book in 1998 that if we kept on printing money the way we did from 1965 to 1998, every house in Vancouver would be worth $5 million. Well, on the west side, we actually hit $4 million a year ago. So like you, I agree the market will be certainly much better in price-wise in the future, no doubt about it. But the second part of the equation is, and you pointed that out, is timing, right? What's the time? When is it going to happen? And clearly, right throughout the history of the market, it's always gone up eventually, but there were good times and bad times. And so everybody, of course, wants to know what's happening with the rates right now. So what is it that you see? Where are they right now?
Yeah. This will be a shock to those that haven't been following rates for quite some time, but most terms are over 6% right now. In fact, the shorter the term, the higher the interest rate. So we're in a weird environment right now. The finance nerds will say that the yield curve is inverted, meaning that shorter term money is more expensive than longer term money. Typically, this is the opposite. The reason that this is inverted is because there's an expectation that interest rates will fall over the next couple of years, not that they will go up. Interestingly enough, this inversion of short-term money being more expensive than long-term money is also a very interesting precursor to typical recessionary periods in the future as well. And so we're in an interesting time where if you wanted a 1-year fix as an example, almost every bank's going to be right around 7% interest, just crazy.
Or 1-year term, which would
Yeah.
have been a 1.5 or 2% a year and a half ago, right?
Yeah, it's crazy how much they've gone up. I mean, we were placing mortgages in 2021 at 1.59%, 1.69%, 5-year fixed. Yeah.
And people said, I'm going to wait till it's 1.4.
Yeah, exactly. Oh, it was crazy time that people like, oh, when going back and forth and shopping it around to find the best rates, like it's 1.69. It's pretty good, right?
Yeah.
Of course, they'd started to go up, and by the time that we were in early 2022, the fixed rates were just a little over 2%, and then they just took off like a rocket. And just over the last 18 months, we've gone from, I would say, low 2s to mid 2s for 5-year money, up to about 6% for 5-year money. And so huge increases. Yeah.
It's not so much even the increases, it's the speed with which the increases were put on us. I mean, I think I put in my OzBuzz newsletter the 50-year history of 5-year term mortgages. And really, there's only 5 years out of 50 where we actually had mortgages, 5-year terms below 5%. But it was all 2016, 17, 18, and like in the last little while. So anybody came into the market that was 22 years old or so and ready to buy, they're used to only those new rates, and they expect rates to go back down there. What is your view? Do you see them ever back at 2%?
I mean, it's probably that at some point in the future that interest rates will fall back to that level. But I also am getting the sense that that it won't be in the near term here. I think that we're going to see interest rates drop, and we'll see them drop over the next couple of years. But the general expectation is that we might get into a situation where the prime rate might be hovering around a new neutral rate zone of somewhere between 3.5% and 4.7%, like somewhere in that kind of range.
Which would be a good rate historically. I remember my whole portfolio in the 80s and 90s was over 10%.
Yeah, exactly.
For some reason, today's 6% is not scary, and you may very well, and I've argued that the government will probably keep the rates there. They won't go back to 2. They may well go into the 4s. So what is happening in the market then, based on the changes in the mortgages?
Yeah, it's interesting. I mean, boots on the ground, we do have less applications coming in the door. There's no doubt about it. So it has decreased. I would say, if I look at my year-over-year numbers, they're down a fair bit, and even 2022 versus 2021 we're down. So we were down about 20% from maybe 15 to 20% from 2022 versus 2021. And 2023 versus 2022 is probably down more like 50%. It's considerable.
Right. But then you were always at the top end. I mean, you were, you had remarkable volumes. I mean, you couldn't expect it to continue, but that's quite a drop. Yeah.
Yeah, it's quite the drop. Another function of that is that a lot of our clients are real estate investors, and a lot of those investor clients decided to just sit on the sidelines and wait this out. A lot of the activity that I see is actually more homeowners purchasing as opposed to investors purchasing, which is interesting. Which historically, investors are always a counterlever to normal market circumstances in most cases, anyways, and they haven't been in this circumstance. So interest rates rising is definitely putting a dampening effect on things. And as brokers, it's not just purchasing volume in the marketplace, but it's also refinancing and renewals. And historically, the refinancing and renewals portion has always been 60% or so of our business, and that has been has significantly dropped just because on the refinancing, who's going to refinance and take a higher interest rate, right? That's not happening.
Not until they must, unless they have to, right? It's coming due. And the expectation is by the Mortgage Institute that I guess next year and the year after, is a lot of the 5-year money is coming due. Right?
Yeah. A lot of it, yeah. And if you look at it, a lot of people redid their mortgages back in 2020, 2021 for good reason. So a lot of those renewals are now getting pushed out. So we have less renewals coming up this year and next year. But on top of that too, it's harder to do anything there. You're not able to move a lot of these clients that are coming up for renewal because the rates are higher. Therefore, the stress test rate is higher. and you can't even move these clients. If you're renewing at an interest rate of 6.29% for a 3-year fixed rate, which is kind of a going rate right now, the stress test rate is 8.29%. You have to qualify as if your rate is 8.29. So these are pretty high.
So it's much harder to qualify in general, but particularly on the stress test side. In terms of qualifying, I understand the banks and the financial institution want a lot more information from us than ever before. I mean, you have been preaching to our investors that you got to get ready. You cannot just sort of wait till the last minute. If you're going to be buying something, get your ducks in a row. What do the banks look for?
Everything. Everything. I mean, the primary is definitely debt servicing. So that's the core that everything revolves around. They want to know that your income can support your debts. And to put this in perspective, it used to be that you could multiply your income by about 5, and that would be your maximum borrowing power. So if you have no other debts and you're just going to buy your own home, you could take your income and multiply by 5, and that would be the approximate mortgage amount you could qualify for. Now that number is multiplying it by 4. So it's compressed by about 20%. It's considerable. So if you make $100,000 a year, you used to be able to buy something for $500,000 or borrow $500,000. Now you can only borrow for about $400,000. So that's definitely an issue and a concern. There are some special programs like net worth programs or self-employed programs where people can qualify, but at the end of the day, even those programs are still coming down to some form of debt servicing. Even with the net worth programs, they say, okay, how much can your income support? And then how much net worth do you have, and adding that liquid net worth on top of what your income can support. Basically saying, well, if you sold off all of your liquid assets, you could reduce your mortgage down to what your income could carry. So everything at its core actually comes down to the debt service ratio, unless you're getting into B lending and private lending, the more expensive funding.
So let's say I have a portfolio of rental income. It used to be a certain percentage of that income would be helping me in my debt service. Is that still the case?
It is, yeah. And so in general, it's about 50 to 80% of that rental income is used. There are some extreme examples where some credit unions will sometimes use up to 85 or 90% of that rental income. Okay. The problem is that those credit unions also come into and out of money quickly. And so when the market was really hot, they had to continue to pull back, and they continue to just change their policies. But they tend to be a bit more fluid, whereas the banks have more rigid policies, and they tend to change a little less. But ultimately, at the end of the day, it is difficult. In Greater Vancouver, for instance, if you put 20% down on a property, it's probably not cash flowing to you, but then to the bank, if they use 50 to 80% of the rental income, well, it's definitely not cash flowing with 20% down. So almost every rental property in somebody's portfolio is traditionally, it's a net negative on your application, not a net positive.
Yeah, the interesting thing is too that investors have to understand they want facts. They want your lease agreements with your tenants. They want anything to do, like you said, everything. I mean, they want the firstborn name of the children that you haven't born yet. And of course, somebody's been in the business for a long time. They don't, oh, well, we don't need that. No, you do need this. Now, banks are scared. Look, it's a scary kind of a world when we have the U.S. government being downgraded, and then you have some 27 banks downgraded, or 10 downgraded, and 5 put on notice. And then you say, and then we forget that there's 4,000 banks in the United States. It's quite normal that one of the other banks, we have 5 banks that has 4,000 branches. They got 4,000 banks at 1 branch. And so it's much more likely for them to have problems. But because there is that anticipated problems that banks have, they're going to be tougher, no question about it. Yeah. Now, is there any changes coming that would affect investors?
Well, yeah. There's one that's coming up, and that's coming up now. It's starting to come up now anyways, which is that a home equity line of credit, you can only re-advance. And as you pay down your mortgage, typically what we would recommend is you get a mortgage that's re-advanceable. So as you pay down your mortgage, your line of credit limit increases dollar for dollar as you pay down the mortgage. However, there's some new policies coming in right now. So it's as of October that the banks have to do this, but some lenders are already making the change where you can still have a mortgage and a line of credit. You can still go up to 80% in total financing. But if you did that, each dollar that you paid out on the mortgage will not increase the line of credit until you're below 65% financing overall. So there's a little bit less extra additional credit you can access. That's something that has come through the pipe. There's also been a lot of talk about changing the way that we qualify for mortgages as well. So instead of looking at a debt service ratio, looking at a loan to income ratio. So earlier I was mentioning, you multiply your income by 4 or by 5, and that's your borrowing power. There is some precedence for this because the Bank of Canada, or at least not the Bank of Canada, but Canadian government has started to use this. For example, the first-time home buyer home partnership program that they used a little while ago, they had some loan-to-income ratio requirements where they would only do it if the loan was no more than 450% higher than your income. So that would be a 4.5 multiplier. So interestingly, I think the UK does use this methodology. And I can say as the mortgage broker, actually, it would make our lives a lot easier, because instead of telling a client, okay, for this mortgage with this lender, for this term, you qualify for this much. But if you go over here to this lender and take this term, now all of a sudden you qualify for a little bit less, because every time the rates change, the qualification changes, right? If you just had a static amount that you qualified for, regardless of the term that you chose, it's actually a lot easier to look at options. And in some cases right now, Ozzie, and I'm not a huge proponent of this, but some of our clients have to take a 5-year fixed rate because it's just the lowest option available in the marketplace, even though we don't think that that's the best option, because now you're locking in for a long period of time at a rate that's kind of at the peak. So it's kind of an interesting situation. We also saw the opposite of this last year, where when rates were moving up, the fixed rates had moved quicker than the variable rates had, because the fixed rates are correlated with bonds, and bond markets started to move up very quickly early in 2022. And Canada was lagging behind. So guess what? Clients taking variable rates could qualify for more money. And so putting clients into variable rates, even though we knew that the rates were going up, because it's the only way that they could qualify for a mortgage. So how backwards is that? That doesn't make sense. So I think that was a concern for the government as well.
But it's very clear to me that you need an expert to help you. I mean, who's going to know all the multitudes of rules and regulations? And the thing is, first of all, do I have a good deal? Do I want to buy a home? I always feel as a homeowner, whenever you can afford it, buy it. Buy the best you can afford. It's done very well over the years as an investment. But as an investor, you just simply have to have somebody that understands your portfolio. And also there's private money out there. I mean, how about private money? Is it still available?
It is, although a lot of the private lenders have had, definitely over the summer, have had a lot more deals coming to them, and they can pick and choose which ones they want to do. And so there's definitely this situation where I've been working on some deals that look doable. You take it to the lenders and they say, honestly, Kyle, I think 6 months ago or 4 months ago, I probably would have done it. But now I've got all these other good, juicy deals on my plate that I'd rather do instead of this one. So they're taking the cream of the crop. So they're
expensive money too. No?
Oh yeah, it's crazy. I mean, you look at it and you're quoting clients, like almost every private mortgage is in the double digits now. And you explain that it's prime plus 4, that's kind of a going rate for a private mortgage. And when prime was 2.45, we were getting private money at 6.5, now it's 11.2 for private money. It's the same prime plus number, but it's just a way higher prime.
Yeah. No question. Again, you need the experts. Now we have on our market where, maybe 3 years ago, high rise was started and they're all coming due early next year, or there's a lot of construction coming due, and some of the people that bought a pre-sale unit maybe thought they could easily afford it at the then prevailing rates, and now they're biting their fingernails. Is there still if you have a pre-sale completing soon? How long in advance do banks guarantee the rate?
Yeah, so in certain cases, you can get longer than this, but most banks will do a rate hold for 18 to 24 months. And in fact, they will fully approve you now, and then they do not need to reapprove you after, as long as you close within that 18 to 24 month window, which is nice. Some banks will offer rate holds that are longer than 24 months. They usually have to approve the project specifically, so there's a bit more due diligence to dive into it. A lot of the time what you'll find is that the bank that's providing the financing to the developer often will be the bank that also has a rate hold kind of guarantee. But usually if it extends and the rate hold guarantee is longer than 2 years, then they also will not fully approve the borrower today and then not have to go back into the qualifications, which is just great. I mean, you could go get a mortgage approval now for a property that closes in 18 months. And as long as it closes within 18 to 24 months, regardless, even if you lose your job, your deal is still fully approved, which
That's kind of amazing, because normally these pre-approvals weren't necessarily guaranteed, because you had to show your employment and all that at the time that you actually took out the mortgage. If I can get it ahead of time, that is really something we want to make sure that we tell to our clients. So if they lock in now, the rates, of course, are very high, right?
They are. So what the banks will do, they'll take the current interest rates, premium them, because they always want to build a cushion just in case rates continue to climb. Then they approve you at that higher rate, and then that's your worst case scenario. So if rates continue to climb, then you still have that rate secured. However, when you're going to close, if the rates with that bank are lower, then you can do a one-time drop before closing. So if the rates do come back down, you still get to take advantage of getting a market rate at that time. So there's really no reason not to do it. You get qualified just in case you lose your job. You have a worst case scenario interest rate, and you still get to take their actual interest rates at the time of closing if they're lower. So
that is a very, very important point. I want to make sure that I share that with everybody. But talk about sharing. Is there anything else you can share, or any tools that you have that would help borrowers at this time?
Yeah. You know me, I love my spreadsheets, Ozzie. So
yes, the best spreadsheet in the world. I've said it for years. You should charge for them.
Well, I've got lots of them. The one that I've been sending out a lot is the question that comes up is, should I lock in my mortgage or should I stay variable, or my renewal's coming up, should I go short-term fixed or long-term fixed, or what should I do? Mm-hmm. So I created a tool that helps compare a short-term fix versus a long-term fix, and it just basically looks at where the rates would have to be upon the renewal of the shorter term for you to be better off or worse off taking the short term versus the long term. So it's not a super complex calculation, but it looks at the break-even rate. So that way you can say, hey, here's the break-even rate. Do you think that rates will be higher or lower than this in 2 years' time if you took a 2-year fixed versus a 5-year, as an example? The spreadsheet also has a tab that allows you to look at a variable rate mortgage versus a fixed rate mortgage as well. So we have and we keep updating the general expectations with the marketplace as far as what's going to happen with variable rates and who actually knows what's going to happen. But we keep that up to date inside of the spreadsheet. That way you can compare what things would look like if that was to come true by being in a variable versus being in a fix. And we're still a bit early to be jumping into variable rates. However, technically, if you have a deep discount variable, technically with the general market expectations, a variable would outperform a fix. But you know what? We also thought that a year ago, and the general market circumstances have changed. So it's hard to feel comfortable putting a client into a variable until we get really tight to that window where we expect rates to drop. But that's been a really useful tool. Last but not least, we've also been working on something where we have a tool now that is going to be introduced to our customers just within the next couple of days, where you can apply with us without sending an application, without sending documents, without doing anything. You just fill in an online form, and then we can take that into our program in the back end, and we can work out an estimated qualification for you. So even if you have 5 properties, you'd usually have to send us like 200 pages of documents just to tell you if you qualify or not. Yeah. With this, give you a high level view of whether you're in the ballpark or not, and then decide if it makes sense to collect the documents and go through it. So it saves time for everybody on each side of the fence.
That sounds very useful because certainly it gives you a snapshot of what's possible or what's not possible right up front. So that makes a lot of sense. Yeah. So in general terms, it's tougher. I think the question also, you always felt that you have to consider prepayment penalties if you are an investor, because sometimes it is better to go short term just because the penalty isn't as outrageous as it could be on a 5-year term. Do you still feel that way?
Absolutely. Yeah, it's definitely a consideration. And so these penalties with fixed rate mortgages is either 3 months interest or what's called the interest rate differential. And that calculation is the difference between your rate and current market rates if current market rates are lower. Well, if we expect rates to drop over the next couple of years, that could increase that spread and increase that cost to break the mortgage. If you have a short-term fixed rate, the way that these penalties are calculated is usually a bit more favorable, and also you have less time remaining on the mortgage, meaning that that penalty is usually smaller. I think that if you're going with a major bank and taking a 5-year fixed rate, there's some level of concern over if you wanted to break that in 2 years' time, your penalty could be very, very high if rates drop considerably. So in general, we're recommending shorter term fixed rates to
yeah, I mean, it's very important. You have to, as an investor, simply sit down and figure yourself out, right? What is my goal, right? I'm looking for a short-term flip. I'm looking for a short-term, then go variable, because the penalty itself might be much more important to understand than a 1% higher interest rates.
Yeah, exactly.
Yeah. So, well, any final words of wisdom that you have?
I'm just starting to see that, and I'm hearing from clients that there are starting to become like a few more deals on the market now. As the market slows, if it continues to slow or stay slow, I mean, frankly, the summertime always slows down. August in particular, it's always slower, less new applicants coming in. But if it doesn't start to pick up again after probably mid-September, which is kind of normal, once the kids are back in school, people start looking again, doesn't start to pick up and there's sellers that really need to sell, there could be some opportunity. So it's always good to be prepared for that. And at some point it will make sense to buy investment properties again. It's just a matter of when. But there's always a good deal. Even if interest rates are high, if you can get a really good deal on something, then it may make sense to pull the trigger. So
I've never seen the best deal at the top of a market. I've always seen when it was perceived to be the bottom of the market. Oh, that's when I should have bought. Well, how do people get a hold of you? I know that you're an extremely busy man, but if I was going to go for that high level evaluation, I would go to your website. Is that what I would do?
Yeah, you can send us an email at info@greenmortgageteam.ca, or you can call us at 604-229-5515. And it doesn't take us very long. Even if you're just coming up for renewal and you just want to get some quick advice on A, are you getting the best rates from your bank? And then B, should I go short-term fixed or should I go variable? Which term should I choose? We can send you the analysis to give you that. It doesn't take us very long to do that. And it just makes people feel a bit more comfortable with the decision they're making. So reach out.
If you listen to this on Spotify or Amazon Music or Apple, and you don't have an easy memory, just go to ozbuzz.ca, go to Ozcasts, and we have all that information that Carl just mentioned, phone number and contact email, and ask him for one of his spreadsheets and try and get it for free, because to me, they are still the best way to figure out what kind of property to buy and the length of term and all we just discussed. And then on YouTube, of course, we also have below, if you're watching this, below all the contact information. Carl, thank you so much for taking the time. Valuable information, and I know every investor and every homeowner is well served to deal with Carl Green and Green Mortgage. Thanks for coming.
Yeah, thanks.